All right, well, good afternoon, everybody, and welcome to this afternoon's session. Hopefully you've all enjoyed your lunch. It's always a little bit of a challenge for me, and I know I do see a lot of familiar faces, so I've used this little joke before, but having to stand up in front of a crowd after they've had a pasta lunch puts a lot of pressure on me to keep things lively and moving forward. So, I'll understand if a few of your eyes roll into the back of your heads and you drift off a little bit. I'll just assume it's because you've had a big lunch. Today's topic is quite near and dear to me simply because, we're going to be discussing the 10 most common options trading mistakes, and I can pretty much guarantee you that I've made all of them. And so you have the benefit of my experience anyways as I was learning the ropes of this particular business. Incidentally, my name is Jason Ayers, and I'm a derivatives market strategist and, of course, instructor with the Montreal Exchange, and always a great privilege to be part of the Options Education Day here. With this particular topic, what you're going to find that we're not necessarily going to be strategy focused, but I will tell you that as you're looking at implementing various strategies within your portfolio to meet certain objectives, if you keep in mind some of these common mistakes, I can guarantee you that you'll save yourself a lot of heartache, as I came to learn over the years. Now, of course, we're going to look at some examples here. Not a lot today, but we'll be referencing a few stocks. And I just want to remind everybody that, of course, the information that we're going to be talking about here this afternoon is for educational purposes only. In fact, that's why it's called Options Education Day, not Options Recommendation Day. So keep that in mind as we're moving forward. That this is to stimulate ideas, to get the wheels turning, but understand that it's repetition and reinforcement that really will guarantee that you move forward with the education process. And we'll talk about a few different ways that you can access various resources when we finish up. Now, we've got a list of 10 common mistakes that we want to tackle throughout the next hour and a half. I'm not going to bore you with rhyming off all 10 in the agenda, but just recognize as we move forward throughout to today's session that we're going to be introducing at least what I believe are some of the most common trading mistakes. And as I mentioned, mistakes that I know I had to overcome and learn the hard way. And we talk about education, and anybody that's gone through the education process recognizes that there's a tuition typically to pay. So what I can tell you is that I've paid quite a bit of tuition to learn from these mistakes. And that's what truly it's all about. And the idea is as long as you learn from those mistakes and that tuition that you've paid does not go to waste, then you can move forward and, of course, become a much more effective trader and investor. I think probably the first most common mistake, at least I know that I suffered from anyways, is the fact that many traders and investors who are looking at incorporating options into their portfolio tend to rely on what I would call market timing. And really the idea is that rather than going in and researching particular option contracts or option strategies, the idea is quite simply, hey, here's a stock, I think it's going to do this, let's grab an option and participate. So whether or not your rationale is either technical or fundamental, the fact of the matter is there are many different pricing variables that are influencing how an option is trading throughout the day. And we have to understand that option premiums will not move in exact correlation with the particular underlying security because of these unique trading variables. And I think a lot of time investors and traders, and I'll rephrase that, stock investors or stock traders rely on a track record where they perhaps have been quite effective at selecting appropriate positions, and they've done quite well with that stock selection. But they ultimately fail to recognize that there are a number of other variables other than just simply the price of that particular security that are influencing that contract's value throughout the day. And of course, in addition to the price of the underlying, we have to recognize that our strike price selection is going to influence the outcome of the position. Our expiration date selection is going to influence the outcome of that particular position. Volatility of the underlying is going to influence, of course, the outcome of that position. And to a lesser degree, but also important in the concept of understanding the different pricing variables, are dividends and, of course, interest rates. So you can see here just with this simple slide that it's not quite as easy as just saying, hey, I could buy a call option or a put option to trade this directional bias. We need to put a little bit more thought behind it other than just simply, I'm going to buy the stock if I think it's going up, or I'm going to short the stock if I think it's going to go down. I always like to look at understanding an options position or an options contract as really trying to manage expectations. Because of these different pricing variables, we again recognize that there are different influences throughout the day that will be forcing option prices to fluctuate up and down or what have you. And many investors are attracted to the options market because of the different the different characteristics, the different approaches to using options, such as leveraging your capital with a limited risk exposure, protecting and preserving your capital, income generation, and of course the flexibility to participate in many different market environments. So it's real easy to see the benefits, and it's real easy to be attracted to utilizing or incorporating options into your portfolio, because all of these characteristics are, of course, I would imagine why you guys are here today, is to really take advantage of at least one of these particular considerations or one of these particular characteristics of the options market. But what we have to understand, again, is that while we're looking to accomplish these various objectives, whether it's limiting our risk and leveraging our capital, whether it's income generation, whether it's protection, whether it's flexibility, a lot of times there's a failure to recognize the unique trading characteristics of the options market. Again, we come from a stock buyer's background, which is simply, I'm going to buy the stock or I'm going to sell the stock, and whatever price you get in, if it goes up a penny or down a penny, you're making money or you're losing money. So it's a pretty simple concept to understand when you're stock trading. And again, we have to pay some credence to the unique trading characteristics of the options market when we're looking to migrate over to that particular market and integrate that particular market into our portfolios. The next consideration that I would suggest is one of the more common mistakes that are made is using an all-purpose strategy. Now, as I mentioned, options can be used under a variety of different market conditions. And the fact of the matter is, I used to think myself that the more complex the strategy was, the more effective it would be at meeting my goals. And I kept being attracted to learning more and more complex combinations and trying to figure out what it all meant and what it was all about. But really, at the end of it all, we have to step back, and before we consider whether we want to use a simple strategy or a complex strategy or some sort of complex combination, we have to step back, identify the market conditions. What kind of an environment are we looking to to take advantage of, and what sort of conditions are influencing the market environment presently? We want to determine what our objectives are. Because options are available to us to meet a number of different objectives, we have to step back, and before we make any decision, try to figure out what it is that we're looking to accomplish, and then move forward from there and apply the appropriate strategy. Now, to give you an example, we've got a table here that reflects 3 different approaches to using options. You'll see that we have options for a directional bias, options for protection, and options for income. And you'll recognize that under each category, we have a number of different strategies that you might look to implement to meet that particular objective. Under the directional section, we have long calls or long puts. We have debit spreads, directional condors, directional butterflies, straddles or strangles. Under protection, we have long the stock, long the put option. We have short the stock, long the call option. We have the caller strategy. Under income generating strategies, we have credit spreads, iron condors, iron butterflies, covered calls, and naked put writing. So while they all serve to meet certain objectives, each one of those strategies has a unique risk-reward proposition. Each one is impacted different from the time depreciation perspective. Each one will be influenced differently from implied volatility changes. Commissions as well, guys. Recognize that we're not up here to say that commissions aren't a reality of these trading strategies. The more positions you put in place, the more legs of an option contract you're looking to utilize, the more commissions you're going to pay, and that might be adverse depending upon what size of an account you're utilizing, and of course your level of experience. There's a different level of management required for the individual just buying a call or a put option versus somebody that's trying to manage through an iron condor, let's say. And so you want to recognize where you're at in your understanding of trading options and managing option strategies, and trade within those means. right? Don't try to trade outside of those means. Stick with what you know. Now, the reality, again, is each strategy is going to perform differently depending upon the various market conditions. And so we need to step back as investors and traders and first and foremost assess market conditions and determine objectives. Okay? We need to research what option strategies are available for us to select. And then finally, and once again, before you ever go and click that button, create a plan to manage that particular position. And if you can't realistically talk yourself through a management plan for a specific strategy, even though that strategy might look like the right one to use, it's probably not a good idea to put it in place until you truly understand what to expect out of its performance and how to ultimately manage out of it. Now, once that's all in place, of course, it's time to click the button. So recognize, just like a pilot who jumps into an airplane, they don't just hit the throttle and go. There's a series or a process that pilot goes through before they finally get cleared for takeoff. And I want you guys to think about that from the perspective of trading and investing with options. You're going to sit down, you're going to go through a process, and then once you've done so, you're going to have a higher probability of choosing the right option contract that is correct for you and your experience level. Now, once that's in place, if you understand the position correctly, and if you understand the different pricing variables and how the market conditions are going to influence that particular position, you will be able to effectively manage your expectations. And I can't even tell you the number of times where, a lot of folks come in. I'll take the example of just simply buying a call option or a put option to trade a directional bias. And there's an expectation that that particular trade is going to yield an exponential rate of return. And sometimes it does. But we have to recognize that sometimes it doesn't. And so when we have the ability immediately to manage our expectations and understanding how market conditions are going to limit profitability or accelerate profitability, we can then manage the position much more effectively. Now, buying cheap options is, I think, probably, it's tough to rank these ones, and keep in mind that the top 10 is not number 1 to number 10 based on importance. But buying cheap options is something that I think a lot of novice option traders do as a mistake, because they, again, are attracted to the fact that they can leverage their capital by purchasing options that are inexpensive. And again, I remember sitting back and looking at a particular opportunity and thinking to myself, okay, I've got $1,000 that I want to risk here. I can buy 10 of these $1 option contracts, or I could buy 20 of these 50-cent option contracts. But at the end of the day, how much money am I risking in that trade? I'm risking $1,000. So my risk is still the same, right? I'm just choosing a different option contract to try to leverage my capital more effectively. But understand that options are cheap for a reason. They're priced based on probability, okay? They're priced based on the probability of whether or not they're going to have a value on expiration. And so when we pay a little bit more for an option contract, we have to recognize that the market is pricing in a higher probability that the stock's going to do what it needs to do to get beyond a strike price. If we buy an option with a cheap premium, it's cheap for a reason. The market is suggesting, okay, it might do it, but it might not do it. And to get you to buy it, we're going to lower the price. Okay? So we need to manage our selection based on probabilities. There's absolutely nothing wrong with buying what we would refer to as an out-of-the-money option contract, but we have to understand why it is inexpensive, why it's cheap, if you will, and manage that position accordingly. Now, here's an example, and I'll get you guys to notice that in your books, the slide reflects a little differently. We're looking at an option contract here, or an actual option contracts on Barrick Gold. Now, this is back July 25th, but we're actually looking at a stock price of $34.50, and we're looking at strike prices at various levels. So I think your slides in the book might indicate that we're looking at a $34.50 strike price, but that's not the case. The options are all September expiration, but they are in fact at different strike prices. And the idea here is that we have the same stock, the same expiration date, okay, and at the same price. But when we look at these three different strike price selections here, we'll recognize that the 30 strike September call option, in this case we're looking at all call options, is priced at $4.80. Now, that is what we would refer to as a deep in the money option contract. And the reason we refer to it as a deep in the money option contract is because with the stock trading at $34.50, if I were to buy that option contract with the $30 strike, I have the right to own the shares at 30. Well, with the shares trading at $34.50, $4.50 of that options contract is in fact what we would refer to as intrinsic value. That means that the balance of the premium, in this case the $4.80, is time value. So you can see that although that option contract is expensive, understand that by buying intrinsic value, we've actually mitigated the impact of time. You'll understand as well that that deep in the money option contract, in this example, had a delta of 0.85. Now, the delta of an option contract refers to how much the option contract is going to appreciate based on a $1 move in the underlying security. So in this case, with a delta of 0.85, if Barrick Gold went up $1, this particular option contract would go up 85 cents. So although we're paying a little bit more for our premium here, what we've done is we've reduced the impact of time, and we've also increased the impact that that stock movement to the upside is going to have from the perspective of an increase in the option premium value. What you'll also notice here, guys, is the fact that our break-even point is $34.80. Because the break-even point of an options trade, when we're talking about trading a directional bias, is based on how much time premium you've actually had to pay for. Because what's the value of time on expiration? It's zero. And so we have to understand that in order for that option contract to have any value on that third Friday of the expiration month selected, it has to have an intrinsic value. So the more time value you pay, the more intrinsic value that option needs to generate for you to break even and then, of course, profit at the, on that expiration date. So in this case, even though we're paying more for that September 30, we're paying $4.80, recognize we only have to compensate for 30 cents in time premium, which means our break-even point from the price at which it was at that current time, $34.50, is as long as the stock's trading above $34.80 on expiration, you break even. Okay? We go down to what we would refer to as an at to slightly in the money option contract. Now, what you'll recognize here is we've significantly reduced the amount of capital required for us to participate. Okay, so for somebody that wants to reduce capital allocation, that at-the-money option contract is going to be a great choice. But when we make that decision, we have to recognize that with the 34 strike selection and the stock trading at $34.50, there's only 50 cents of intrinsic value, which means there's $1.50 in time value that we need to be aware of. And as we make that choice to select an at-the-money option contract, you'll notice that the delta actually drops down, in this case, to 0.56, which means if the stock goes up $1, the option contract is going to appreciate by 56 cents, theoretically. Okay? And our break-even point, in fact, has to increase because no longer do we have the benefit of only paying 30 cents in time. Recognize that we now have to compensate for $1.50 in time. And so we need to add that to the strike price and add the premium to the strike price, and we get a higher break-even point. Now, the interesting consideration comes, and again, common mistake, one that I've made, is looking at that 40 strike and saying, man, can I ever buy a lot of option contracts at 30 cents? But understand that the delta reduces significantly down to 15 cents. Now, that is attractive. Because on a percentage rate of return, guys, I pay 30 cents. If the stock goes up $1, I make 15 cents. It's a pretty nice rate of return. But understand, if I am the type of investor that maybe likes to look at my account every couple of days or every week or so, understand that by me being more passive, time is passing by day after day after day after day. If I fail to pay attention to what's happening with that particular contract, understand that if, as time passes by, My break-even point is, in fact, and that should actually adjust to $40.30, but either way, we have to see that stock trading above $40.30 to break even. Now, we can look at it in the perspective of a price chart for those of you that want to look at it from the relationship of a chart. Understand that with the stock trading at $34.50, if I buy that 30-strike option contract, you'll see that little green arrow indicates how much that stock has to move for me to have my money still available to me, or that option premium still be worth $4.50 on expiration, or $4.80 on expiration. It only has to move a certain amount. When I choose that at-the-money option contract, recognize that that stock has to make an even greater move to the upside in order for me to break even on expiration. And then finally, we choose that out-of-the-money option contract and recognize that the stock has to move significantly greater than both of those selections in order for me to, in fact, break even. So even though I'm paying a very small premium, I need that stock to move much more significantly in order for me to break even. And remember what I suggested earlier on about risk assessment. Whether you're taking $1,000 and buying 3 option contracts at $4.50, or you're taking $1,000 and buying 30 option contracts at 30 cents, you're still risking $1,000. And so our job is to select the option contract that gives us the highest probability of being correct over the particular time frame that we've selected. Okay? So again, it's not to say that you can't benefit from an at-the-money or an out-of-the-money option contract or an in-the-money option contract, but you need to recognize that your choice is going to have significant implications, not simply, hey, if the stock goes up, I'm going to make money here. Your choice of your selection will, in fact, determine the outcome of the particular position that you're looking to create. So this is what we need to pay some close attention to. So a couple of general rules of thumbs, guys. Out-of-the-money options perform best when a quick or volatile move is anticipated. So if you happen to be want to be or aspire to be an options trader, and you're prepared to manage a position on a shorter time frame, then an out-of-the-money option contract is a fantastic way to increase your percentage rate of return on a stock that you believe is going to make a very quick move. The drawback is that they have a higher probability of expiring worthless. So if you just simply sit back and try to let nature take its course, eventually time is going to catch up with you and you're going to be wishing you had taken action, several weeks prior. And the other consideration is that they lose their value more quickly on an adverse move. Okay? So if you think about that, the further out of the money I select in my strike price, absolutely, the further that stock has to move in order to break even. If the stock moves that much further against me, then we need that stock to move significantly greater at the expiration date to compensate for that. And so what will happen is the market will depreciate that contract very, very quickly, in which case, again, you'll be suffering from greater losses, whereas that at-the-money or in-the-money option contract, they're more expensive, but because we're paying for a smaller amount of time, we have the ability to be a little bit more passive, understanding that it's not time depreciation necessarily that's really significantly influencing the value of the position. It's more so the underlying security that is influencing the value of that position. Okay, so one of the sort of analogies that I use, and of course I never like to equate trading and investing with gambling, but the idea of going to the racetrack. And you'll recognize anybody that's been, I don't need a show of hands, by the way, but anybody that's been to the racetrack will recognize that you can bet on the long shot and you can bet on the favorite. And if you bet on the long shot, well, man, that thing, if it comes in, is going to give you a pretty handsome return. Might pay off 10 to 1. Now, you bet on the favorite, and it may not pay off as much, but the probabilities of you walking out of there, having bet on the favorite with a little bit of money in your pocket, are significantly greater than you betting on the long shot, okay? So just keep that in mind. When we're making our selections, we want to try to select the option contract that has a higher probability of finishing, okay, if that makes sense, of being first across the finish line. So that even if the stock moves in our favor, absolutely, out of the money is going to make money, at the money is going to make money, and in the money is going to make money. But what happens if it doesn't? What happens if the stock stays the same? What happens if the stock goes against you? That's what we have to manage for. Okay? The other consideration as well, just to add to this, is that the at the money and in the money options have that higher delta. And so what happens is that your position is going to be benefiting more closely to a move in the underlying security price, because that delta, as I mentioned, is how much that option contract is going to appreciate in value based on a $1 move in the underlying security. So the higher the delta, the higher that option contract is going to be influenced by that move. And another very interesting consideration is that the more the stock moves in your favor, the higher the delta gets. So if we happen to choose an at-the-money option contract with a delta of 0.56 in this example, if the shares start to go in my favor, that delta is going to increase, and the more it increases, the more I benefit from that stock move. Okay? So these little considerations you can step back and look at before you actually start clicking the buttons and place an options trade. Now, the other consideration as well is expiration month selection. Short-term options are cheap relative to longer-term options because they have a lower probability of being in the money on expiration. So understand again, cheap is not always better. Okay, a lot of us are value shoppers. I'm guilty of that. I shop at Winners. I'm always looking for a bargain. But at the end of the day, cheap is not always better. You have to recognize that just as options are cheap because they're out of the money, options will also be cheaper because they have less time until expiration. And so when we consider that the delta is the measure of how much an option contract will increase in value based on a $1 move in the underlying security, what we have to recognize is that the measure of time depreciation is referred to as theta. So what happens is that the theta is a reflection of how much the option contract will drop in value on each day moving towards expiration. So how much will that option contract decrease in value as we move closer to that option's expiration? It works against the options buyer. So as somebody that is looking to integrate options into their portfolio to trade a directional bias, what you have to understand is time depreciation is something that we always have to manage for. Okay? What we also want to understand is that as an option writer, time depreciation is what we take advantage of. So depending on which side of the trade you're looking to be on, we will manage accordingly. As an option buyer, we need to manage for time depreciation. As an option writer, we want to try to take advantage of time depreciation. So the investor that does purchase a cheap short-term option contract really can potentially fall victim in being right about the direction but wrong about the time. In fact, I will tell you that my very first trading mistake, where I lost my entire position, not my entire portfolio, my entire position, was a combination of simply relying on market timing, but also adapting or adopting that idea of more is better. And so what I did is I labored over a stock for a day, reading the charts, analyzing support levels, resistance levels, moving averages, MACD. So every indicator that you can think of, I'm throwing up on this chart, trying to determine a directional bias, right? And once I finally decided that, yeah, this thing's going to go up in value, I thought, okay, I only have $1,000 to put on this particular opportunity here. And again, I can buy 10 at a dollar, or I can buy 20 at 50 cents. And it had to do with the time factor, right? Because again, the closer to expiration, the cheaper the options contract. So I thought, well, Jay, you've pretty much analyzed this chart to death. You know you're going to be right. You know you can't be wrong. I mean, you're doing everything that you've been taught, and everything is lining up. And why not just do the shortest term possible? Why not leverage your capital as much as you can? Because, man, this is going to be a home run. You're going to go out and buy that car you wanted and all that sort of stuff. And I felt really good about it. And I don't know if anybody's been in this position, but the next day the stock does nothing. And of course, well, that's fine. It's going to happen. I can't be wrong about this. And the next day, and then the next day. And of course, you guys know where I'm going with this. I ended up holding that position until expiration with the hope that the stock was finally going to move in my favor, and I let those options expire worthless. And what do you think happened with that stock the next week? Once my options expired worthless and I managed to take that, had to take that loss, $1,000 gone, that stock significantly rallied in my favor and never looked back. So, a lot of times I hear people say, stupid options, what is it? I couldn't blame anybody but myself, because when I sat down to look at my choices, did I have to choose a 1-month option contract? Absolutely not. I had the choice to give myself more time to be right. Because remember, we're dealing with probabilities here, okay? Just as we're dealing with probabilities in our strike price selection, we're also dealing with probabilities in the time that we allow ourselves to participate in a potential move. And if you give yourself a little bit more time, understand you can always close the position the next day. You don't have to hold that position until expiration. So a lot of times what happens is investors are right about the direction, but they're wrong about their time selection. So one rule that I adopted is, if I'm trading a directional bias, whether I think it's going to happen tomorrow or 3 days from now, I'm going to give myself 2 to 3 months. Because if the stock goes against me a little bit or goes sideways for a little bit, no big deal. I've got some time. If the stock moves in my favor very quickly, no big deal, because I can close my position. But what I've done is I've given myself a nice little buffer to weather against a position that could conceivably go against me before it goes in my favor. Okay? So again, the probability of an option contract being in the money on expiration will diminish as that particular date gets closer. It's kind of like me suggesting, what do I have a better chance of being right about? That it's going to rain tonight? Or maybe I should say that the sun's going to shine sometime today versus in the next couple of weeks. Okay? I have a higher probability of being right about giving myself another couple of weeks versus predicting that it's going to happen within the day. That's how the option contract is priced as well. And so what you'll find is that time depreciation on an option contract is not linear. What happens is we will pay a higher premium, but by paying that higher premium, we have a little bit of a buffer to allow that stock to fluctuate a little bit against us, to move sideways, before finally it starts moving in our favor. And traders will tend to hold on to those option contracts. They won't liquidate their positions as quickly if the stock is doing nothing. But as we move closer towards that expiration date, understand that the option contract premium, or that rate of time depreciation, will accelerate exponentially. So the longer we hold that position, I'm going to give it another week. Well, recognize the rate of time depreciation isn't going to be the same that next week. It's going to have increased. So every time you give yourself a little bit more time, this rate of time depreciation will continue to accelerate until such time you're sitting there at options expiration, and if the stock hasn't moved, the option's going to expire. Now understand, once again, if we take a look at an example here, now this is Agrium. Keep in mind, guys, I had to have this presentation in the summer, so that's why you're seeing July quotes here. But Agrium, trading at $94.30 on July 26, we can look at call options here at various expiration dates, okay, but all at the same strike price. And what you'll notice is, of course, the premiums will differ. You have your August expiring options trading at significantly less than the others. The theta is 0.049. So what this is telling us is that essentially every day that passes by, that option contract is losing half a penny. Okay? We look at the September option contract, and it's worth $3, but you'll notice that the theta, or the rate of time depreciation on any given day, is 0.029, or essentially 0.3 cents per day. And then finally, we look at January 2013, which of course is past, but at that particular point in time, yes, the option contract was more expensive, but the rate of time depreciation on a day-to-day basis was somewhere along the lines of just under 0.2 cents, or 0.02 cents. And so what we have to understand is the closer we get to expiration, the more influence that theta is going to have on the position. Now, when we understand the dynamics of how an option contract is priced, we have to understand that for the option buyer, theta is always a negative. Every day, that time depreciation is chipping away at the value of your option contract, which means that the more time value that is chipped away, the greater that stock has to move in order to accommodate for that. Okay? So the longer you wait, even to lock in profits, the longer you wait to make a decision, the more that time depreciation is accelerating, and the greater that stock is going to have to move in order to either bring you back to a break-even point or, in fact, ultimately bring you into a point of profitability. Okay? So what we have to consider is that options are cheap for a reason, and we need to manage accordingly. A longer dated option contract is more expensive, but for individuals that want to be a little bit more passive, folks that know that, hey, they can't be looking at their positions all day long, then you're going to want to look to choose a longer dated option contract that is going to be less impacted by time. Although you're going to be putting up more capital, what you do is you position yourself on a much more subtle point on that time depreciation curve, and you give yourself a little bit more flexibility to manage the position. Now, again, it gives you more time for your forecast to play out. The rationale that I use for myself, and I trade a lot of shorter term directional plays using options, but I really step back and I say, okay, if I buy a short term option contract and I'm right, then yeah, that's going to make me a pretty respectable rate of return. If that move happens very, very quickly and I'm right, that's going to make me some pretty good money. But if I'm wrong, I have a greater risk of losing that capital. Whereas if I choose a longer dated option contract and that move happens very quickly, am I not still going to make money? Absolutely. I'm still going to be able to generate a rate of return on that position. But the difference is if I'm wrong and the stock happens to take a little detour, where that out of the money option contract or that longer dated option contract is going to be expiring very, very quickly, I've now given myself a little bit of a buffer to allow that stock to make an anticipated move within a longer period of time. Okay? So the other consideration as well is that if I choose a shorter dated option contract where we have an opportunity to take profits on a very short period of time comes up, okay, a lot of times the idea is, okay, well, I still have another week, to take my profits. But recognize that, again, even if I'm profitable at a certain stage of this shorter dated option contract, we're still going to be impacted by that rate of time depreciation. And if I don't act quickly, then I could conceivably lose it. Where if I've given myself a little bit more time, I have the ability to stay with the position and participate in a trend a little bit more effectively. So we need to choose the appropriate option contract based on what our objectives are and how we are comfortable with managing the particular position. Okay? If a longer-term option contract is selected, always remember that you can close that position at any time. So if Monday morning, even if I bought a January 2014 option contract on Research in Motion, and Research in Motion skyrocketed within the next couple of days, I don't have to hold it until next January. All I've done is I've given myself a little bit more time to participate, but ultimately I can lock in profits at any particular time between now and that expiration date. Okay? One of the probably the most widely misunderstood pricing variables, if you will, is the impact of implied volatility on one's options contract. And typically the concept of implied volatility is usually saved for an advanced tutorial because it is a fairly complex variable that takes a little bit of understanding. But what we need to understand, or what we need to learn as a novice option trader, is again how to manage expectations. And failure to understand implied volatility or ignoring implied volatility can lead to serious disappointment. Again, I've learned my lesson the hard way as well. What we have to do is we have to understand that there's two types of volatility that need to be considered. One is implied volatility, Okay? And one is historic volatility. Now, historic volatility is in fact a measurable unit, if you will, based on the underlying stock. It's in fact the past realized volatility of the underlying security. What historic volatility does is it measures the standard deviation of the stock price from the average price. And so we can get an idea that a certain stock has the ability to move 10% up or 10% down throughout a certain period of time, or 15 or 20% or 30%. And incidentally, the more volatile the stock, the higher the historic volatility. So a bank stock, let's say, for example, depending on what it is going to have a much significantly lower historic volatility than a stock like Research in Motion. So even though the stocks might be priced the same, historic volatility is going to be different based on how much that particular price is moving away from the average in any particular time frame. So what happens is the options market will take that into consideration. And so, again, you might have a bank stock, you might have Research in Motion. The option premium for the bank stock, if the stock price is the same, is likely going to be less than that of Research in Motion, because Research in Motion is a very volatile stock. And so what happens is the option premium will start to reflect what's known as implied volatility. So even though the stock has been behaving in a certain manner, the understanding is such that historically that stock is pretty erratic. It can do anything. It can go up, it can go down very, very significantly within a short period of time. And so that implied volatility reflects the market's expectation of future volatility, and it's an adjustment for risk. What we have to understand is that in the options world, we're not trading against or with one another. We're working with a market maker. And that market maker's job is to be the opposite side of every trade. They're the buyer to every seller. They're the seller to every buyer. So if I want to buy put options, or I want to buy a call option, as a call option buyer, I have a right. But that market maker is taking on an obligation. If you go back to options basics, the option buyer has a right and a limited risk exposure. The option writer gets paid but assumes an obligation. So what happens is the market maker takes a look at the stock and says historically it has the potential to do this, 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 and this. But I'm seeing something on the horizon that suggests that the future volatility might be increasing. I now have to take on the responsibility or the obligation of fulfilling this particular contract, whether it's a put or a call, so I need to get compensated for that accordingly. So the market maker will increase the option premium as a function of implied volatility. Stock may not have done anything, but the potential is there, and as a result, the premium increases. This could be company earnings, which we're going to talk about in a few moments. This could be pending announcements or mergers. Could be based on the economic environment. In fact, if we think about the whole idea of price adjustment, what happens is the changes in implied volatility are going to be influencing that option contract even if the stock remains stable. And so when I go back and I talk about the idea of managing expectations, we have a lot of folks that come into our office or ask questions that say, you know, I bought this call option and, you know, the stock really hasn't done anything, but, you know, the option premium has lost a significant amount of money. And there has to be a recognition that even though the stock hasn't done anything, and even though maybe very little time has passed by, the implied volatility factor can be influencing that option contract in the absence of any move in that underlying security. So you need to manage expectations. We don't want there to be any surprises. You need to be able to recognize that, okay, yeah, the option contract adjusted. Well, why did it adjust? Okay, why did it adjust? And recognize that implied volatility could be one of the factors. Now, what an understanding of implied volatility does is it helps us, again, manage expectations. And you'll notice that I've in fact used that term, I don't know how many times today, manage expectations. Okay, a lot of times we're attracted to the options market because of all of the great benefits, but we have to manage our expectations. We have to learn what the strategies are all about and how these strategies are influenced by these different variables and manage our expectations so that we could make more effective and educated decisions moving forward. So we manage our expectations, and through this, we're also able to make better contract and strategy selection decisions. I'll give you a prime example. We know that if implied volatility increases in a call option, let's say, and that measure is the vega, okay, which we're not going to talk about in great detail here, but that measure is the vega. Well, I know that if I implement what's known as a bull call spread, I buy a call option with a high vega, but if I sell a call option at a higher strike, it also has a vega, but that vega is now negative. It's working in my favor as the option writer. So what I've done is I've recognized that implied volatility is high on an option contract that I want to use, and I've adjusted my strategy selection to offset the impact of the variable that I've identified. Okay, so without that knowledge, it's quite conceivable that you just go in and buy any old call option and the stock goes up a little bit and you don't make any money and you'll wonder why. Well, it's because you didn't factor in the implied volatility variable. Okay? The other way that we can look at implied volatility is a measure of what we call the sort of fear factor of the market as well. So here we have a snapshot of the S&P TSX 60 VIX-C. So it's the volatility index, and what this is reflecting, it's reflecting implied volatility on near-term and next-term options on the S&P TSX 60 index. What this suggests is that during certain market conditions, okay, implied volatility on options are either going to be higher or lower. So in this case, we know that the S&P at this present time, and still is in fact trending higher. And so the market environment is suggesting that it is one of limited risk. And as a result, what happens, because the VIX or the VIX-C, the VIX is in the US, the VIX-C is in Canada, has a negative correlation to the stock market historically, implied volatility tends to drop when markets are trending to the upside. Okay? Think about it, and we'll get back to this, but think about it like insurance, your insurance premiums. Okay, the less risk you are to an insurance broker, the lower your premium. And so in a market environment where the investors and traders and money managers are not feeling that there's a lot of risk, option premiums will be cheap, okay, relative to what's to historical time periods. So if we go back here, hopefully I can I don't know if I can demonstrate this on both sides here, but you'll see that in an environment where the stock market has dropped, you'll notice that the VIX-C spikes, okay, and so on and so forth. So it has that negative correlation. So if you want a sort of a general read on what the current market environment is, then you could look at the VIX-C, and with the VIX-C being very low, that is suggesting that relative to historical time periods, options are cheap. To me, from a portfolio management perspective, this is a perfect time to buy insurance. So if I have a portfolio where stocks have been trending higher and I'm profiting and I'm feeling great and I'm feeling comfortable and I'm feeling complacent, if I know that options are inexpensive historically, then I can use this VIX-C to judge that and go in and consider utilizing put options as a means of managing my portfolio. So again, when we talk about common mistakes, you really need to recognize just how important volatility is to the options market, and whether it's making portfolio decisions or whether it's making strategy selection decisions, make sure that you're integrating that into the process that you've started. Okay. Now we're going to talk a little bit more about the impact of implied. Yes. Yeah. Sure. Yeah. Well, so for example, and just to keep it very simple, and you guys, the question is, what are the different strategies that one might look to implement during a period of low implied volatility? And that's a fantastic question. So the idea is that under periods of low implied volatility, option premiums are relatively cheap. So it's a good time conceivably to be an options buyer, to take advantage of buying calls and buying puts to trade a directional bias, to look at protecting stocks that you've had in your portfolio whereby they've increased in value. So, and I don't want to get too in-depth with strategies, but during a period of low implied volatility, I might be inclined just to buy a put option to protect a particular stock. Why? Because the option premium is reasonably cheap. But if implied volatility expanded and those option contracts became very expensive, what I might consider doing is a caller strategy, going in and selling a call option, collecting a premium, and using that premium to offset the expensive option contract. So we can step back, compare volatility levels historically, and decide, can I just buy a put for protection, or should I consider a caller for protection? Again, these are some strategies that we're not going to get into today, but that would be how we would look at implied volatility as a factor. Also, again, during this particular time frame, if we're considering a directional move on a stock, I talked about the idea that a company like RIM, for example, implied volatility is extremely high. Well, I might consider a bull call spread or a bear put spread to offset the impact of implied volatility. But if I could recognize that implied volatility and historical volatility are reasonably close to one another, then I might be more inclined to just simply buy a straight call or a straight put, because I don't have to worry about the implied volatility factor. And we're gonna build on that here in a couple of minutes, because one of the common mistakes is disregarding earnings and dividend payments. And disregarding earnings really has everything to do with understanding the impact of implied volatility, because option premiums will typically increase into earnings due to an increase in implied volatility. And what's happening is you're looking at the option seller, because remember, you're going to be a buyer. You're looking to buy either a put or a call to participate on an earnings report. But the option seller is saying, hey, I don't have a copy of the report. I don't know what they're going to come out to say. So how can I protect myself? Well, I got to increase the premiums. Think of it in the context of comparing two insurance candidates, two car insurance candidates. You have a young kid, 17 years old, just got his license or her license, bought a fancy sports car, high-powered sports car, never got into an accident before, hasn't done any damage, hasn't gotten a speeding ticket. But what do you think the insurance broker is going to do when this kid applies for insurance? Are they going to have a reduced insurance premium, or is it going to be a high insurance premium? The kid's unpredictable, okay? Young, inexperienced, high-powered sports car, right? Who knows what's going to happen? So historically, kids that are young, inexperienced, and have a high-powered sports car have a tendency to get into trouble. So your insurance broker, or the insurance broker, is going to price the option contract, price the insurance premium accordingly to compensate for that risk. Then you have a father of two, drives a minivan, car seats in the back, or a mother of two, what have you, has 20 years of driving experience, no speeding tickets, no accidents. The insurance broker is going to say, well, you've demonstrated some consistency, and we can see a reasonable probability that you're not going to get into an accident. So your insurance premium is going to be lower. That's how market makers essentially look at pricing the option premiums. In the event of unknown risk and uncertainty, they will demand a higher premium to compensate themselves for taking on that greater risk, just as your car insurance broker will. And so what typically happens, and we've seen this time and time again as well, is that an investor believes that a stock's going to make a significant move on an earnings report, and it could be lower, could be higher, it doesn't matter, and they want to buy, in this case the example is lower, and they want to buy a put option to participate. What they have to recognize is that implied volatility, every day that the stock, or every day that we're getting closer and closer to the earnings report, implied volatility is expanding, right? So what happens here, and I'll give you probably an example that many of you might be familiar with. What you'll see here is this is a snapshot of the research in motion chain just before an earnings report back in December. And you can see that research in motion, in the green box there, is its historical volatility. It's its 30-day historical volatility. It's at 68.14%. Is RIM volatile? Absolutely, absolutely. But what I want you to recognize is take a look at the implied volatility factor on the December option contracts. Okay? The stock's trading at roughly $14. I don't have that boxed in there, but the stock's trading at $14. The December 14 strike at the money call option and the December 14 strike at the money put option is demanding a 20% greater implied volatility premium over and above the historical volatility of the stock. Why? What's going to happen on earnings? Nobody knows. And so ultimately what happens is anybody that was buying that very short-term option contract that was expiring just at the earnings report, just on earnings there, would be paying this implied volatility premium. Whereas if you take a look at the expiration date, let's say of January 2013 here at the bottom, recognize that the implied volatility factor is down at 80.2. It's still very, very high, but you'll notice that there's a difference. And sorry, the December is about 30%, but you'll notice that after the earnings report, the market maker is saying, okay, we're going to decrease the same strike, so the same strike, 14 strike, the implied volatility consideration is only 80%, not 100%. So you'll recognize here that by buying those December at the money strike calls or puts, you are paying a very, very significant implied volatility premium over and above the implied volatility premium that's factored into the January, so 1 month later, call and put option contract. Okay? Now, what happens is implied volatility can be measured on what's known as a distribution curve or a bell curve. And not to get too overly technical, but what happens is that during regular market conditions, a market maker will actually price the option contracts as a reflection of its historical volatility. So the idea is that they will price the option contract based on the probabilities of the stock trading within a certain range. So in this particular example, you can see here that we have a stock sitting at $50, and the market maker is saying, hey, based on historical volatility, I know that over a certain time frame, the stock has the potential to either trade down to 45 or up to 55. Okay? That's how a market maker prices options. You know, folks that think market makers have a directional bias any given day, they're there just to make a market and to factor in that a stock can go up, either up one day or either down one day, and they need to manage the risk associated with taking the opposite side of the trades. So in this particular case, under normal circumstances, you would have a market maker that is pricing options based on a regular regular trading activity in the stock. And so this would be an environment where if I looked at the historical volatility and I looked at the implied volatility, they would be reasonably close to one another. But what happens as an earnings report or some sort of an unknown variable starts to come into the picture, the market maker will expand or widen out that distribution curve. And the market maker will now be looking at the potential for that stock to trade down to, in this case, 42 or up to 58. Remember that a market maker really only takes on a risk if they have to deliver on the obligation they've taken, which simply means that the stock has to be trading above or below a specific strike price. Remember, an option contract only has a value on expiration if it has intrinsic value. So the market maker is stepping back and evaluating the environment and saying, okay, yesterday there was the potential for this stock to only trade between 45 and 55, which means all the option contracts beyond those strikes are likely to do what? Expire. Now all of a sudden there's an unknown variable, and that market maker or the market in general does not know how to evaluate the risk. So what they have to do is they widen out that distribution curve and they say, okay, with this unknown variable in mind, I need to manage my risk between 42 and 58. And they'll do that utilizing a number of different strategies, but one, and the one that's most important to us, is they will increase their premiums. So the stock may have not done anything, but the implied volatility factor is expanding, commanding or demanding us to pay more. Now, ultimately what happens, and I've seen this happen time and time again, after that earnings report takes place or after that event takes place, implied volatility contracts. Okay? So this is what we call a volatility crash. So in other words, you paid a high premium because implied volatility was high based on an expectation. Now that expectation is long gone. It's history. They already know what happened. So the market's going to sit back and say, okay, well, it didn't really do what we thought it was going to do. And so premiums will contract. And what happens now is the market maker says, okay, implied volatility or uncertainty was increasing up towards that earnings report. Now, ultimately, we have that report behind us, and we have to recognize that, hey, the stock's going to start trading within that regular historical volatility that we've been used to, and premiums will contract. So the risk to the investor, and again, that common mistake that folks make, is that they want to participate in an earnings report with aspirations of hitting a home run because they think that the stock is going to make a huge move in a very short period of time. But they fail to realize that if they pay when implied volatility is high and that implied volatility collapses or contracts or crashes, that option premium will drop in value. And so what will happen is you'll see the stock move in your favor. Okay, so remember this. We've talked about a couple of pricing variables here. So we talked about the delta, right? We talked about the theta, and we've talked about the vega, which is implied volatility. So think about the idea that when you buy that option contract just ahead of earnings, you're paying a significant premium. Okay? And what happens is that premium is priced based on uncertainty. As soon as that certainty comes into uncertainty becomes a reality, implied volatility contracts. And we might see a drop, let's say, of maybe 10, 20, 30% in implied volatility. Well, understand that while implied volatility contracts and drops the value of the option contract, we have the options delta, which if the stock moves in our favor, will add to the value of the option contract. But the biggest risk is that what if implied volatility contracts significantly greater than the impact of the delta? Now all of a sudden you're left with an option trader that says, stupid options market, the stock went up, I thought it was going to go up, I knew it was going to go up, and I bought an option contract and they told me that a call option will appreciate. Why did I lose money here? Well, why did you lose money? The contraction of implied volatility was not, or let me put it another way, the move in the underlying stock and the impact of the delta on that option contract was not sufficient enough to compensate for the collapse in implied volatility. So you were right about the stock move, but because you did not pay attention to implied volatility, you lost on the trade. Okay? So something to consider as we move forward. How do we manage for that? Well, if you want to participate in an earnings report, you need to recognize that the earlier you buy the option contracts, you can in fact benefit from an increase in implied volatility, or look to implement a bull call spread or a bear put spread, which creates a volatility neutral position, which allows you to benefit from a move in the stock while mitigating the impact of volatility. Okay, so these are the thoughts that you would be going through before just inadvertently buying a simple call or a simple put option. So again, you can be correct about your forecast, but you incur a loss quite simply because of your option strike price selection, your option expiration selection, or the fact that you've simply ignored implied volatility. Okay? Now, the other important consideration here, guys, is the idea of uncertainty. Okay? Earnings also represent significant uncertainty in the pricing of a stock. Now, I'm not talking about how it actually impacts the price of an option contract, because we've discussed that in the context of implied volatility. But recognize that if all known information is already priced into the stock, there is the potential for a surprise. And so while you may have a directional bias on a particular security, recognize anytime you choose to hold it through an earnings report, it's like a gamble. It truly is. Because you could see a significant move based on one little comment that the market did not anticipate, and ultimately what looked like a bullish trend ultimately turns into a fairly significant drop because of that one little variable that nobody factored in. And the idea as well, we're going to talk a little bit about a couple of examples here. But when we look at the impact of dividends, okay, what we have to understand is that dividends also have to be factored in, and that's from the perspective of an options writer. Now, we know that dividends are one of the pricing variables that influence the value of an option contract. But what happens is a lot of time individuals who look to incorporate the covered call strategy into their portfolio fail to recognize that if that particular stock is a dividend-paying stock, they may in fact be assigned to deliver the shares ahead of an ex-dividend date. So that would be what's considered to be an early assignment. And the reason why this might happen is, let's say the time value remaining in that option contract is less than the dividend that's getting paid out. Well, the call buyer might feel that there's a financial benefit in owning the shares in receiving the dividend versus holding that call option. And so let's say the call option's worth 20 cents, but the dividend that's being paid out is 40 cents. Call option holder might exercise, take the stock, okay, incur that 20-cent cost, and then ultimately collect that 40-cent dividend. So those of you that hold dividend-paying stocks within your portfolio, you really do want to recognize that if you are coming towards ex-dividend, there is the potential that that stock might be taken away from you. Now, there's ways that you can manage for that. Okay, number one, you can roll the option contract. So in other words, you can in fact roll the contract to a higher strike, or you could go out to a further expiration date, or there's ways that you can manage for that. But it's important to understand what may conceivably happen so that there's no surprises. You might expect that there's going to be a nice juicy dividend sitting in your portfolio the day after the day of ex-dividend, but all of a sudden realize that not only do you not have the dividend, but you don't have the stock anymore as well. And so managing expectations, understanding what potentially could happen, and taking action to manage accordingly. Now, what we're going to look at here, I think, is something that whether you're a short-term investor or a short-term trader or a longer-term investor, is probably something that we all have suffered from at some point in time, and that's the idea of waiting too long to close your positions. There's always that question of what might have been. You're holding your favorite stock and you watch it go so significantly in your favor, and you're so happy about it, but then you continue to hold, and then it turns around and goes against you, and you didn't lock in your profits, and as a result, you feel compelled just to keep holding it. This sort of roller coaster ride that takes place when you're on the winning side of an investment. The idea and what I really believe is a real challenge and a real hurdle to overcome for a lot of novice options traders is that we in the beginning embrace the buy and hold mentality. And there's nothing wrong with that if you're prepared to manage for that, because that's in fact how we're taught. I remember when I first started learning about stocks, well, in fact, it was mutual funds, but what's the principle that's taught? Don't worry, a little bit in a month, just keep putting it in. Market's always going to go up, you're fine, don't worry. And so psychologically, we are taught that the buy and hold mentality is a right way to do it. And there's nothing wrong with buying and holding a position, provided that you recognize what your objectives are, and you recognize certain points in time where, hey, yeah, it's appropriate to take some profits, because it's not a profit until you take a profit. It's as simple as that. If you're holding it in the market, then it's there for the market to take away, right? So one of the other things that we have to understand as well, particularly when we're trading options, is that the more time we wait to close the position, what's eating away at our profits? Time, right? The more time we wait, the more time is impacting the option value. So what might be a 50% profit today, if the stock does not do anything, we have that little thing called the theta. Every day, that theta is chipping away at your premium. If the stock's not moving higher, if the delta's not influencing the value of the option contract to the upside, theta is chipping away at it. So what may be a profit today, if you fail to take action because you say, well, I've got another month, so I don't have to worry about it, every day that you wait, you are actually losing value. because time does not wait. Just like in life, you never get it back. It's always passing by, right? So what we want to recognize is that the more time that passes by, as I said earlier on, the quicker that time depreciation accelerates, and the more that stock has to move in your favor to compensate for that. So what would have been a fantastic 50% profit 3 days into the trade is now a mediocre 20% profit 2 weeks into the trade, which might be a 10% profit 3 weeks into the trade, which might be break even in the last week, and a complete loss on expiration. All because you just did not have a plan to take action. Here's a perfect example here, guys. Many of you are familiar with a little company called Research in Motion, now affectionately renamed BlackBerry. But the idea here is on January 18th, okay? We're looking at a a January 18, 2013 expiration 14-strike call option. And what you'll recognize is just ahead of a few weeks ahead of earnings in November, a month or so ahead of earnings in November, that call option expiring in January was worth 17 cents. 17 cents, okay? We were well away from earnings, a couple of weeks away from earnings. Option contract is worth 17 cents. Now, at the time just before earnings, you'll recognize that that option contract was worth $1.46. Now, there's two lessons in here. There's two lessons in here. Number one is the recognition that, hey, man, when you get a move like that and you are looking at that ahead of an earnings report, you're better to err on the side of caution, because an earnings report, yeah, man, it could work out in your favor, but sometimes it doesn't. And if we take a look at just the difference that one day made, okay, on that earnings report, that option contract went from $1.46 all the way back down to 24 cents. Now, were you still making money? Absolutely. But would you not be a little disappointed at having not taken action ahead of the earnings report? You know, general rule of thumb is stepping back and saying, hey, I've made a really nice profit. I'm now looking at an event within this particular company's history that is an unknown variable. We don't know what it's going to do. Could go up, could go down. So the way I look at it is that if I hold the position, in this case, if I hold the position through earnings, I could make substantially more. No question about it. But on the other side of it, okay, I could also lose it as well. And so erring on the side of caution and simply just taking actions, you're never going to catch the top. You're never going to catch the bottom. Our job is to catch what's in between. Take action ahead of earnings. Because of the unknown variable, you'll recognize that had you not done that, the stock drops and that option contract is readjusted to 24 cents. Now, this is a really interesting example because we had a very, very significant turnaround in that particular stock over a very short period of time. But what I want you to recognize is even though that stock turned around and rallied higher than where it was prior to earnings, you're 46 cents lower. You're 46 cents lower than where you would have been had you just taken the profits ahead of earnings. So what I want you to think is the emotional toll that that takes on an individual. The idea that you're up 17 cents to $1.46. Now you're down to 24 cents. Do you hold on? I don't know. And you wait for it. Now, absolutely, it came back in your favor. But it's that old question, man, I wish I had just taken action. I wish I had a plan to close that position ahead of earnings. Now, the risk that one was taking at that particular point in time is the stock was trading up around 15 bucks, right? $14 option contract, $15 stock, you've got $1 intrinsic value. But understand that if the stock dropped back down to 14, what's that option contract going to be worth? Zero. Your break-even point at the time when you purchased that 14-strike option contract, which was significantly out of the money, was $14.17, right? If we go back to what we were looking at in the beginning with respect to selecting out of the money options. Now, could you make money on this? Absolutely, but you have to be prepared to take action. And incidentally, if anybody knows what did happen on expiration in January, the stock was at $15.66. So, yeah, holding on, you would have made money, and you would have made more money if you hadn't have closed it out ahead of earnings. But point being, why put yourself through that? If you have a plan, if you trade that plan, and we're going to talk about this in much more detail in a few moments, but if you have a plan in place, okay? You will not fail to take your profits because you will recognize points within that stock or within the trading characteristics of that stock that will suggest to you that it's time to take action. That might in fact be simply buying a put option. You bought the shares. You know earnings are coming up, okay? You don't have to close the position, okay? But failure to even manage that position, failure to even lock in your profits is doing yourself a significant disservice, okay? So the next, as we move forward here and we move into wrapping things up here over the next little bit, what I want to recognize here is the idea that one of the very important considerations is failing to plan or create an exit or repair strategy. Now, of course, I know that there's a class going on repair strategies here this afternoon, so that might be one that you want to pick up in video when it becomes available on the Exchange site. But when we step back and before we click the button, we have a plan in place, we actually relieve a lot of that psychological roller coaster ride that many investors experience on a day-to-day basis. And so a simple consideration here is plan the trade and trade the plan, okay? And I know it sounds very, okay, that's easy, but plan the trade and trade the plan. And you guys have probably heard this before, but whether you're a short-term trader, whether you're trading options short-term, whether you're trading stocks over a longer time frame, the fact of the matter is, what we need to do is before we ever click the button, we plan the trade and we trade the plan, so that we have a series of benchmarks that we're looking for to make take decisive action. Failure to plan generally results in an unwilling investor. Okay, I don't need a show of hands, but I'm sure at one point or another in your sort of history of investing, you've been an unwilling investor. In other words, looking at a particular stock and saying, man, I hate you. I hate you and I can't stand looking at you, right? You're unwilling, and it becomes, we've all gone through it. And what happens is, then you stop opening up your account because you can't stand looking at it. Why? Now, instead of you being in control of your portfolio is in control of you, and you are an unwilling investor. And an unwilling investor will make emotional decisions and often irrational decisions, like not opening up your portfolio, like ignoring what's going on in the markets because you just don't want to look at it. You never feel in control. Again, I don't need a show of hands, but I can tell you myself, when I started, I was out of control. I had no idea, in certain circumstances, how I was going to manage through positions, because I always felt like I was suggesting with my earlier example, buying that short-term option. I always felt that, hey, man, I'm going to be right anyway, so what does it matter? But you learn very quickly that that's not the case. So not feeling in control is an awful, awful way to live, right? And it can affect a lot of aspects of your life. And what it also does is, unfortunately, it allows us to, it creates a situation where we allow profitable trades to turn into losing trades, okay? And again, depending upon your time frame, we don't necessarily have to be taking profits every single day, but if we're a longer-term investor, we can look at longer-term observations in our stocks. We can follow longer-term moving averages. We can follow longer-term trend lines, right? So it doesn't mean that you have to be taking profits all the time, or we can implement put strategies that allow us to stay with an investment, but at the same time hedge that risk exposure. The bottom line is, what we're doing is we're creating a plan to make sure that we are in control of our portfolio and not the other way around. And the other consideration here, and I already mentioned this, but typically, if you fail to plan the trade and trade the plan, you end up holding on to losing investments, clinging on to hope. And then we go back to that philosophy that we were taught in the beginning, which is, hey, don't worry about it. It's going to go up. The markets sometimes come down, but most of the time they go up. And hey, that's the case under certain circumstances, but it's all relative to when you buy and when you sell as to whether or not that philosophy works. Okay? Because nothing goes up in a straight line. And the other thing that they tell you is, okay, how long is it going to go up for? And how long is it going to go down before it goes up again? So that buy and hold mentality and that philosophy whereby, hey, don't worry about it, everything always goes up in the end, is all well and good. But what about the people that wanted to retire back in 2008 at that market bottom? How did buy and hold work? Okay? Or back even in 2000. Again, the idea is we have to consider time, and we need to manage our portfolios according to when we're going to need that capital. Because if you happen to need that capital at a time when the market has dropped significantly and you've lost a significant amount of your profits, is your advisor or your friend saying, you don't worry about it, it's going to come back, is that going to do you any good when you want to retire today? Absolutely not. So we want to have a plan and we want to manage accordingly. We also, what I say is set targets. I'm getting the big 10 minutes, so we also want to set targets, guys. And again, it doesn't matter what the time frame is. I always say, look at creating a roadmap. You guys wouldn't go on a trip without having some sort of plan in place. We either, back in the old days, I just remember my parents unfolding this great big roadmap and a lot of arguments ensuing over it. But fact of the matter is, hey, you're going on a trip, you don't know where it's going to end, you're going to end up. You've got a destination, but how are you going to get there? How do you know if you've taken a wrong turn? Well, you look at a map, right? Same with investing. When you get into an investment, yes, you have a destination, and that destination is profitability. But at the same time, what if that stock takes a little detour? Are you still heading towards profitability, or are you heading towards ruin? It's no different than are you heading north or south on a road trip. You need to stop, collect your thoughts, reevaluate the environment and where you're at, and make sure that you are on track. And if you're not, you got to plot another route to get to where you want to go. So you plan that roadmap. When you do this, you preserve capital, you manage risk, and you maximize returns. Okay? There is nobody that's going to tell you that you cannot get back in to a trade, right? A lot of times investors are afraid to take profits because they think they're going to miss more profits. And it's funny that the emotional tie to not making more money is significantly greater than that of the potential for loss. You think about that. People are more inclined to hold on to a position so they can make a little bit more money than they are concerned about how much they can lose on the downside. You have to switch that around. You have to switch that philosophy around and manage for the other side. Okay? Risk versus reward. How much more reward is there versus the risk of losing everything here? So by doing that, you're going to end up preserving capital, managing risk, and maximizing your returns. You can use a number of predetermined technical signals, as I mentioned, support and resistance levels, any other indicators, trend lines, moving averages, whatever it is. But if you have these things in place ahead of time, you've got a set of rules that now you wake up in the morning and you see the stocks taking a little detour. No panic. You step back and you get yourself back on track, okay? Rather than not knowing what to do and panicking out of the market, or now adding to the position because you're dollar cost averaging, you now have a plan to get you back on track. The other, and this all ties into, again, having a plan, compromising your risk tolerance to make up for last losses. Losses are a part of trading and investing. If there's anybody in this room that says they haven't lost on a trade, I'd like you to come trade my portfolio, please, because losses are part of the business. Okay? It's as simple as that. So what we have to do is we have to make sure that we're following the plan, because you're not going to plan to add to a losing position. If you have a plan, you're going to manage for that losing position. The decision to take more risk to compensate for a loss is usually an emotional one. What philosophy does it come from? The old dollar cost averaging philosophy. Hey, if you loved it at 70, man, you're going to really like it at 65. Hey, man, you bought it at 65, you're going to love it at 60. Okay? You're dollar cost averaging your own capital into a losing trade. Okay? And remember, time is one commodity we never get back. So you can dollar cost your way into an investment, and you could say, yeah, man, I'm now averaged down a half of what I paid for it, but okay, how long did that take you? And now how long is it going to take you to break even again? So, adding to that a losing position and adding more risk to your portfolio is not the answer. Know your risk tolerance and trade and invest within it. It's as simple as that. Follow an appropriate plan and you will avoid falling into this trap. Okay? Trading too many positions at once, guys. Common misconception is the belief that a strategy with a limited risk exposure requires little management. Okay? This gives the investor a false sense of confidence that can lead to opening too many positions. The fact of the matter is, even though you're trading a strategy that has a limited and identifiable risk exposure, there's still a risk exposure. And if you fail to manage that risk and your options are consistently expiring worthless, that's money you're never getting back. And it can lead to doing some significant damage to your account. So the idea is that we have to remember that each position needs to have its own plan of management. And if you have too many positions within your portfolio, particularly when you're just starting out learning the options market, your focus is going to be spread way too thin, and the analogy that I use is like a juggler. Okay? The more balls a juggler adds to the repertoire, okay, the more skill required to keep those balls in the air. It's as simple as that. So if now all of a sudden you've got, instead of 3 positions, 10 positions, that means that you are trying to execute a plan on 10 separate positions. And are you going to be able to do that? So what we need to do is we need to take it slow and steady, guys. When learning a new strategy, we need to start with a few positions and smaller position sizes. That way, if you do mess up, hey, you know what? Your risk was not all that significant. It's your tuition, let's say, like I was talking about earlier. Follow a plan and evaluate often. Are you on track? Just like when you're on a road trip, take a look and make sure that you're following the right direction that you set out on. And if not, make sure you get back heading in that right direction, and add positions only when you've demonstrated proficiency in managing your existing ones. So manage 3 very well and add a 4th next month. Manage 4 very well and add a 5th next month, and so on and so forth. Look at it kind of like giving yourself a raise. Okay? The more effective you are at doing your job, okay, then the more you should feel it appropriate to compensate yourself by adding an additional position. And finally, make sure that the number of positions is in line with your trade plan. What's very easy to do is we tend to look at a maximum risk exposure for our portfolio at any given time. What is the exposure of our portfolio to the market at any given time? And as we add a new position into that portfolio, we recognize that that adds more risk. And if you fail to realize how much risk you have allocated as a whole, and you just keep adding positions, what can happen is you'll turn around and you'll look one day and you've got way too much exposure based on what your trade plan has set out. So anytime you add a new position, calculate, okay, this gives me X exposure to this market being bullish versus, hey, I've got, or vice versa if the market is bearish. Okay? Now, this last one, guys, I want to finish up with, and I left this for last because I think a lot of times it's probably the most overlooked common mistake that any investor or trader makes, and that's not paying attention to psychology, to your emotional capital, if you will. Many beginning investors, and in fact, some experience, and every now and again, we all, my partners and I, will suffer from a little bit of this as well, but many beginner investors and some experienced investors overestimate their probabilities of achieving positive results. Okay? Just like that first example where I lost, I overestimated my ability to time the market, and I underestimated my risk of loss. Okay? A lot of investors use the I knew it sort of mindset as validation. So in other words, you watch a stock and you stand on the sidelines and you see that it does what you thought it was going to do and you say, oh, I knew it. So then you go and based on that I knew it mentality, you take action on another stock because you thought, hey, I was right about this one. Now let's go all in on the next one because it looks the same. Okay? So that I knew it mentality is another way of getting yourself in trouble. A lot of investors fall victim to analysis paralysis. In other words, whether it's technical or fundamental, at the end of the day, you can pour over as many reports as you want, or you can use as many indicators and oscillators as you feel appropriate, and you can take as much time as you want to assess and evaluate an opportunity. But as you're doing that, the market is passing you by, and your success is really only going to be dependent upon your risk versus reward management and your ability to lock in profits and manage losses. So, whether you flip a coin and you manage it accordingly, or whether you spend 3 hours analyzing a price chart, at the end of it all, it really comes down to how you follow your plan. Many investors also suffer from denial, okay? And that goes back to that buy and hold mentality and the fact that, you do all of this analysis and you invest your time in making a decision. And you finally get the courage to click the button, and all of a sudden the stock's going against you. But you don't want to believe it. And so you hold on to it, and you hold on to it, and you hold on to it, and deny the fact that you made a bad choice, right? What happens is we suffer from all of these different psychological roadblocks, if you will, at any given time. And probably one of the most common is that being easily swayed by fear and greed. That idea of trying to squeeze that extra couple of nickels out of a trade while ignoring the potential for a much more significant downside risk, or listening to something come out on the news and now all of a sudden liquidating your account simply because of one little piece of information that came out without stepping back and truly evaluating the market environment, or without considering perhaps adding a protective strategy versus all out, succumbing to that market fear. So if you can step back and at any given time when you're looking to implement a particular trade or an investment or so on and so forth, I want you to think about these various psychological traps and think of how you can avoid them. Okay? And finally, following that herd mentality, think for yourself. Think for yourself. Your neighbor's not always right. The idea is that if you are able to evaluate the markets accordingly and evaluate risk accordingly, remember, it's your money that's at risk. That dentist that you saw the other day that gave you that hot tip on some mining stock isn't putting his money up. He's recommending you to put your money up. You are the only one, right, that can assess whether a particular trade or investment or strategy is right for you. And just because everybody else is doing it and everybody else is buying this stock or that stock, hey man, if the herd is heading in a certain direction, what I always say is follow the herd, 100%, okay? An uptrend is the herd driving a stock to the upside. A downtrend is the herd driving the stock to the downside. I want to be in that herd, but what I want to do is I want to be able to evaluate when that herd is about to run itself off a cliff so I could take myself out of it, right? So that doesn't mean just settling in and just following the tail in front of me and just whatever happens, happens. That means always evaluating the market and making sure that you're thinking for yourself. So when we talk about understanding all of these psychological traps that a typical novice falls into, successful traders and investors are disciplined, so they recognize all of the different considerations that we talked about here today, whether it's options trading or whether it's stock trading. They follow a methodology and they possess good money management and risk management skills. I'm going to leave you with this one last thought, guys, and I don't know whether you guys are familiar with an individual by the name of Benjamin Graham, but I really do love this particular quote. Benjamin Graham is considered to be the grandfather of value investing, and in fact, he is Warren Buffett suggests that he is one of the most influential individuals in his life. And Benjamin Graham did a really good job about describing Mr. Market and recognized that we all do business with Mr. Market on a day-to-day basis. And he suggests that Mr. Market is your eternal partner in investing. He is a patient, if not somewhat bipolar fellow, subject to wild mood swings. He is always willing to offer you a bid or an ask. If you are a buyer, he is a seller, and vice versa. But do not mistake this for generosity. He is your opponent. He likes to make you look like a fool. Sell him shares at a nice profit, and he happily takes their prices so much higher that you're embarrassed to even speak of them. Buy something from him on the cheap, and he will show you exactly what cheap is. And perhaps the most frustrating of all, and this I believe is truly one of the most important considerations, guys, is Mr. Market has no ego. He does not care about being right or wrong. He only exists to separate the rubes from their money. Now, I'm not suggesting that any of us here are rubes, But if we don't recognize the things that we can control in our portfolio, particularly when it comes to trading and investing with options and all of these little different mistakes, and if we don't recognize some of the things that we can take action on at any given time, then all we are doing is we are just simply opening up our portfolio for Mr. Market to do what he wants to do with. And that is not how you become successful in this business. So I want you to remember that, guys, that at the end of the day, the market is going to go up, the market is going to go down, and it's going to do that indifferent to who we are and what we do on a day-to-day basis. And whether we're a good person or a bad person, or whether we're bullish or bearish, the market is going to do its thing. So all we can do is simply recognize where we can make potential mistakes and control them where we can, and move forward and make sure that we have a plan in place regardless of what your approach is, whether it's longer term investing, whether it's income generation through covered calls, whether it's options writing through credit spreads, whatever it is. Always have a plan in place, and always step back and take some time and evaluate what it is you're about to do before you in fact do it. So thank you so much, guys, for this afternoon. I think I've gone 5 minutes over, but hopefully you don't mind. Thanks, folks. Appreciate it, guys.